Hello, and thank you for joining our webinar today. I want to welcome everyone to our presentation, Tax Cut and Jobs Act for Businesses, What Business Owners Need to Know for 2018 and Beyond. This is part 2 in our 4-part series. If you missed part 1 on the individual tax changes, we welcome you to visit our website, www.rcthornton.com, and watch the recording from our speaker series page. This webinar will also be posted to our website within 24 hours of this presentation. We do have 2 more webinars coming up in this series. The next one will be Tuesday, January 23rd on commercial real estate tax changes, and the last one on Thursday, January 25th for professional practices. If you would like to sponsor one of these webinars for your colleagues or with a trade association, please give me a call at our office for details. We would love to work with you on your specific topic of interest for your business. Our speaker today is Chuck Thornton from R.C. Thornton and Associates. He's a CPA who specializes in tax planning, compliance, and tax representation before governmental authorities. Chuck has lectured locally and nationally on tax topics such as tax law, management, business valuations, and strategic tax planning. Both the American Institute of Certified Public Accountants and the Arizona Society of Certified Public Accountants have honored Chuck as the Speaker of the Year. If you have any questions during this presentation or after, please email those to Chuck and he will get back to you. His email is chuck@rcthornton.com. So without further delay, let me get Chuck to present our topic today.
Okay, well, good morning, taxpayers out there. Happy taxpayers, I hope, or I hope you're going to be happy after you listen to all the good stuff that's happened for business owners. By and large, it's going to be a very positive situation. Now, some of you are actually watching on the PowerPoint slides. Some people actually have the handout. So what I will be doing is I'll be talking and I will say slide number such and such, so that for the viewers out there that are just using the hard copies, are able to do that. By the way, just a little bit of a warning, just a little bit of a thought on this is that these handouts, these materials are available for anyone here who is on the presentation. It's available for your friends and colleagues. I would ask that you respect they are copyrighted by us and that they not be used for any commercial purposes or transferred to any commercial outfit for utilization on this. Now, next thing too, I have been watching this tax law proposal change ever since almost the time that Trump got elected, to tell you the truth. I was somewhat surprised all this went through. I think a lot of us were skeptical on that. And indeed, most of the stuff he talked about actually did go through. And so far, about the only thing that's out there is a copy of the text of the code, which is just now getting assimilated into the Internal Revenue Code, committee reports, which put you through all sorts of what the House and the Senate says, and very little editorial commentary and writing is out there other than just quick articles that you might find on the internet. The reason I say this for several reasons. First of all, I don't want you to feel sorry for me for all the time that I spent on this, or I don't want necessarily to applaud, but you will read a lot of things on the internet that people just heard somewhere, and they will go ahead and write an article. Sometimes they're very accurate, sometimes they're not. Sometimes they were thought to be accurate and they may not turn out to be accurate. So I'm not suggesting this is the definitive word on everything, although I think it's very reflective of the law change. I'm obviously looking for opportunities in this. But as regulations come out and rulings come out, things may change. And I'll try to pinpoint the areas that I think could change. There could be technical corrections acts that come out. So this is kind of a fluid situation right now because this is just a total overall and all new. Now, let's take a look at the major points we're going to discuss. We're going to talk about C, corporate tax rates. We're going to talk about this 20% pass-through deduction, and I'll sometimes refer to it as 199A. So there's a new vocabulary for you. Have you taken your 190A deduction? Talk about interest paid limitations, depreciation changes, limitations on losses, but I can tell you the big one, big news for people are the 20% pass-through and deductions. Now, Next Thursday, we'll be talking how this could apply to professional groups. I'm going to keep that as a separate topic because it gets complicated with professional entities such as doctors, lawyers, and groups like that. Excuse me. So anyway, we're going to do that, and we're going to have one on real estate. So we're going to get much, much more expansive in a lot of the depreciation rules, and also the 20% when it comes to real estate, which is going to be next Tuesday. So if you have commercial real estate, non-residential, even residential to some degree, I guess you might be interested that you rent out, you're using your trade or business, you probably ought to listen to this. If you are a physician, lawyer, someone in the service business, you probably ought to listen in on Thursday to that, or make sure you go to our website and take a look at the slides and information that we will have. So talking about slides, let's go to slide 4. Okay, what's a corporation? Very simple. I won't spend a lot of time on that, but a corporation, basically, it's something that's formed at the state level, or you could be a LLC, you could be a partnership, and you can make an election to be a corporation. You could make an election to be an S or a C corporation. We do quite a bit of this. Many LLCs, we just simply make elections to be treated as corporations, and sometimes S. Now, why do that? You keep the limited liability of the state law, but you get the advantages of the corporate law. So that's why you do it quite often. Okay, slide 5. Okay, from a historical perspective, C corporations have had lower tax rates for about the first $100,000 of income. They started basically at 15%. The problem of it is they had a double tax. You enjoyed that low tax rate in your C corporation, but eventually the cash builds up and you kind of want the money out, and you start borrowing and then you don't pay it back. And then the IRS comes and says you have dividend problems and things like that. Then you pay it out and you wind up having a double tax. So that was some of the pluses, a little bit of a lower tax bracket, but if you were too successful in your business and your income was too high, you wind up being subject to a double tax. S corporations, they came out, I think, in 1958. They basically are a pass-through entity. And so what happens is the income that is on your subchapter S, or a partnership will be the same application, tell you the truth, just comes right through to your return. So therefore, if you only had $50,000, you could have had $50,000 tax at the C corporation. And if you left it in there, you never took it out, chances are you did pay a little bit more tax at the individual level. There's also some possible FICA, that Social Security tax savings, and you never have a built-in gains tax. And all that means is that if you sell the assets of the business, you don't wind up having a tax twice. Now, I could spend probably an hour talking about these topics. For our clients, we probably already discussed these things with you. But what I'm suggesting is that the S corporation generally is better than a C corporation. In fact, I think most of our C corporations long since ago have converted into an S corporation. Okay, slide 6. Okay, so if you take a look at the punchline right now, look down at the bottom. There's what the tax rates were. Remember I said up to $50,000, you would have been taxed at 15%. But starting in 2018, it's just a flat 21%. So right off the bat, flat 21%, that sounds pretty good. In fact, that throws you almost into the bracket of the $50,000 to $75,000 level. There will be a lot of people asking the questions. 21%, that sounds pretty good. Maybe I should go back to the C corporation. Maybe I should be a C corporation. And we expect a lot more questions like that, except for, of course, the people who are watching our presentations right now. So what I want to show you is that don't be lured into the C corporation just because there's a 21% tax bracket. So let's take a look at slide 7 so I can show you this. Very simple. Let's just say you did want to be a C corporation right now because of this law change. I just threw out some examples here. These numbers could have bounced anywhere I wanted to. MFJ in my slides means married filing joint. And you have a taxable income of $310,000 individually. However, your C corporation is taxed at its level, and so therefore you make $1,000, it's taxed at 21%. $210 worth of tax. Pretty simple so far. Certainly less than what would be if it was taxed individually. However, remember that profit is now in the corporation. If you're using it for your business, you're plowing money back into inventory and work in progress, maybe 21% may be worthwhile. But eventually, small businesses get to a point where they're looking to take cash out beyond just officers' compensation. And so I threw in the $310,000 just because the tax rate for an individual at that level is 24%. And so their tax, if they said, okay, now that I pay the corporate tax, give me my money out of the corporation and you take it out as a dividend, the tax would be $190,000. So you would net $600,000, or if you were a mathematician here, effectively the double tax means that you've paid a 40% tax rate. And so had this been a sub S, it just would have been taxed at your 24% rate. Now, the higher your individual income tax bracket goes, the more costly this double tax is going to be. So don't be quick to say go to the C corporation. I could think of a few reasons why you might want to, but in most cases, maintaining your S corporation is going to be a good way to go because you don't want to have this eventual double tax that can come up each year or even down the road with that built-in gains tax. Okay, slide 8. So here's the big one. Now we're talking about people who have pass-through entities, and for this discussion purposes, it means a non-C corporation because it wouldn't apply to a C corporation. You already got your 21% there. So there was some attempt by Congress to basically say, well, these subchapter S, these partnerships, and even proprietorships too, which would be a Schedule C in your tax return, to get some type of parity on this. As I looked at the House and I looked at the Senate, it was so convoluted. They wanted to say, well, a certain amount would be return on your capital, eligible for different rates, It went on and on and on. And even the Senate finally said, why don't we just give everyone a deduction for 23% of qualified business income? However, the final conference committee came out and said you get a deduction of 20%. Now, this 20% is in effect a phantom deduction. Sounds good so far. If you have $100,000 worth of income coming from your business and you get a deduction of 20%, it's $20,000. If you're in a 33% tax bracket, you get $6,600 just for having this type of business, this pass-through entity. Now, that's going to be pretty powerful, but there are a lot of definitions, and I'm going to go through the generic definitions. Someone could have a situation that maybe isn't right on point there, and we'll take a look at some generic stuff, but I'm going to leave the real gory details. If you all were CPAs taking a seminar on this, I would probably be a little bit more detail oriented. So how's this sound? Sound interesting? Well, let's go to slide 9. Okay, so now when you're thinking about what you're going to do with all that tax savings you're going to get, let's start picking this apart. Let's kind of dive into it and start thinking about what the implications are. To get this, it's your share of your income coming through the S corporation, the partnership, or if it's proprietorship, it's all of the income. And what it's called is now qualified business income, QBI, section 199A. That is the new code section that basically had not existed before. By the way, this does replace the domestic production deduction that was available for domestic activities like contractors and things like that. So the qualified business income is a deduction. So get those terms in your mind, QBI, section 199A. What QBI means, it's income from any trade or business, which means we need to dissect that term trade or business in a moment. Other than a specified service, trade, or business, or a trade or business of performing services as an employee. So I want to build on this a little bit because it's going to be important for a few suggestions I'm going to have down the road. First of all, when it says specified trade or business, those are basically doctors, lawyers, accountants, other type of service businesses, people where the business for the reputation of one person is important, is quite expansive. They do not get this deduction unless their taxable income is less than $315,000, and it gets phased out between $315,000 and $415,000. I'm really not going to talk about qualified service businesses anymore. I might mention it on our slide because I want to really pick this apart down the road, and there's some clever ways that you can separate income from being a service versus being a more of a service, a support type business, but too much for this discussion here right now. So keep that in mind if you're a doctor, lawyer, accountant, if you're in the trade or business of a service, you really want to stay tuned and listen to our seminar that's coming up on Tuesday. So the rest of this is now a trade or business of performing services as an employee. What's that mean? If you have a subchapter S, and you take a W-2 from that, well, it would seem like you made that from a trade or business. And in fact, your wage earnings are considered to be in a trade or business, but you could have just easily gotten a W-2 form from any other company that you don't even own. And technically, you would have been in a trade or business. So they just simply carved it out. And they said a trade or business of performing services as an employee are not allowed, i.e., it's a W-2. So if you work for someone that has no application. Now, for people who are already thinking, if I have a subchapter S, maybe I shouldn't pay any wages, and I am not suggesting that, but we will look later about maybe we ought to reconsider what your wage level is, because if the money is the profit, the QBI is coming through your pass-through, or you would have reduced it by taking wages, since wages won't count, there is a inclination to want to reduce your wages and have a higher QBI. We'll talk about that later, but I am not suggesting just go off the payroll or pay yourself some ridiculously low amount. So what components are not part of the QBI? Okay, it must be associated with a trade or business. Trade or business is where you're working, you're managing the operations. There's lots of definitions on it, but one that I fear will be a problem for people are people who have commercial real estate where they have triple net leases. Now, triple net lease is pretty much someone who just rents the property out and they don't pay the property tax, they don't maintain it, they just kind of let you use the place, but you got to take care of everything. A lot of commentators and myself agree with this, is that a triple net lease probably does not get itself to being tantamount to being a trade or business because there's not much to be done, versus a net lease where you pay the property taxes and you hire some management company to do some management aspects for you, and you're a little bit more involved in this. So for people with commercial real estate, we're going to talk about that next week also. You might want to listen on that because we'll be talking about some strategies. And I think a lot of people have triple net leases. If you have them with non-related businesses, you're probably not going to change those. But if you're leasing them to your own operations, we might want to consider visiting these triple net leases that you probably have. It doesn't include effectively any investment income. For instance, it doesn't include dividends and interest and things like that. That would be great if you could get a deduction for that. It does not include reasonable compensation. You can deduct your wages. That is just repetition of what I said before, and does not include guaranteed payments to a partnership. So let me mention this here before we talk about some strategies. A guaranteed payment is like saying, okay, you and I are partners. We're in a partnership. We're in an LLC. We don't get wages. We don't get a W-2, but Chuck, we'll guarantee you, $20,000 for all the work that you do. And after that, we'll split all the profits 50-50. That $20,000 guaranteed, I'm going to get that, is kind of like in lieu of a salary. And so that gets picked up in my income on my tax return. And just as wages, that will not be included in the computation. So if you're thinking ahead, maybe there are some strategies here, because in a partnership structure, you're not so stuck with the issue of having to have a reasonable compensation being paid out. I was just looking at someone's partnership agreement, and lo and behold, they had lots of guaranteed payments. I think we're going to go back and say, why don't we change the way we do this? Because I could increase their QBI Of course, I decrease our guaranteed payment, same normal result, and I could get a 20% exclusion on this. So big planning opportunities here, both for S corporations, C corporations, and quite frankly, from a point of view of a proprietorship, I guess you had the built-in solution already. By the way, some of the things I talk about, this is my interpretation of it. I wouldn't be surprised if there's some technical correction acts that comes out, but there's some great opportunities here at this point. Boy, I better pick it up because I get so excited on this stuff. Okay, page 10. So while you're still thinking about that, we talked about what a service trader business is. You can just look at that very briefly, health, law, accounting. There are some interesting conflicts that I've found in looking at different code sections. It's a 1202 and I think it's a 448. And the committee reports refer to a 448, I mean technical, which opens up the door from some interesting strategies for the people in the professional service businesses. Again, not really going to talk about that until next week, but I just want to alert you that not all is lost if you're a doctor, lawyer, accountant, and so on. Okay, slide 11. Certain principles apply. Just kind of generically to understand this. Qualified business income starts with taxable income, excludes investment income. It's a deduction on 25% of qualified income, hence foreign source income would not apply. And once your taxable income exceeds $415,000, the deduction is further limited to. Now, it's kind of interesting. This exclusion limitations that we're going to talk about actually is computed on your share of certain items, and it is based on taxable income. So there's a kind of a variety of computations that have to be done. So if you go through and you were going to prepare your return without reference to this, and your total taxable income exceeds 415, then it's not just 20% of the qualified business income, but it's limited to the greater of 50% of your W-2 wages. So if the W-2 wages in that business was $500,000 and you're a 50% owner, then for you, the computation would be $250,000. And those wages could be your wages taken from the entity and all your other employees. By the way, this was not the House version when they were proposing this. And I thought this was really going to be a backdoor way of making sure everyone paid Social Security taxes on everything coming out of the corporations. It didn't turn out that way. This is good. So it's 50% of your W-2 wages, or it's the greater of 25% of your W-2 wages, plus 2.5% of the unadjusted basis of your property. Now, the unadjusted basis of your property, this 2.5%, this is going to be an important situation for people who have low or no wages, but they have a high amount of property, i.e. commercial real estate comes to mind here. Almost no one has a W-2, but so they would have flunked on the 50% of W-2 wages, or 25% of wages, zero, plus 2.5% of the unadjusted basis of the property. Okay, let's take a look at slide 12. Okay, so let's see. I'm going to give you an example, but I want to talk about wages for a moment. Perhaps let's go back to slide 11, if you would, please. A lot of clients have multiple entities, and whether you're a client or not, you may have the same situation anyhow, where you may be leasing your employees from a PEO, a personnel employment organization, where they manage all the W-2s and health insurance, all that stuff, and you pay whatever it is plus some type of markup on that. Or you might be using your own internal leasing. You might just say, our management company will lease the employees to these entities. Or you may even have what's called a common paymaster. We have all three of those situations. And so when you say 20% of the domestic qualified income, your taxable income is over 415, but it can't exceed the greater of 50% of the W-2 wages. And let's forget the second one just for a moment because I'm focusing on wages. Suppose the wages are actually paid by the leasing company. Suppose they're paid by the common paymaster. and the leasing company is yours or not, you might not actually physically have what looks like W-2 wages on your entity return because you might be leasing. And the question becomes is, should you not do that anymore? And I have been listening in on a few national seminars. There's a few of them coming out now. One commentator made a comment. He says he thinks there's going to be some more guidance coming out on this. I think that there might be caution to think about this. However, my reading of the code section, because this was really important to us because we have quite a few of these situations, it says that the wages must be allocable to the entity. Well, that's pretty easy. Whether you lease, you common paymaster, whatever, clearly you have people working in an entity. It must be allocable. And it says a payroll return, the end of the year payroll returns must be filed no later than 60 days after the due date of the payroll filing, which means your common paymaster, your leasing company, or your own internal leasing company would have filed that return. My interpretation is, and there's caution here in the wind because not everyone would agree with me, is you can allocate those wages to your entity and someone filed those wage reports within the 60 days. The only catch, the only concern I would have on my interpretation is this. You're leasing to some outside company or from some outside company, and they're not a quality organization, and they're not remitting the taxes, or they just get sloppy and they get late filing their returns. And then now I think even under my interpretation, you've lost your deduction. So if you're leasing from an outside organization, you might want to at least undertake something that verifies that those returns have been filed. Some leasing organizations actually have outside CPAs that come out and certify that, and some don't. But I think doing your homework on an outside leasing organization is important because under, again, my interpretation, you would lose your deduction. I think you're okay, but maybe a little bit of caution, and maybe in another month or so, something will come out from the IRS. Okay, now back to slide 12, please. Okay, just a couple examples. I'm only going to give you two. When you get to our one for the real estate, I'll probably do more than that. Excuse me. So anyway, here's a person that has $150,000 Schedule C, just to make it easy. It's always income, QBI income. $50,000 of not, whatever. It could be pension distributions, it could be wages, it could be investment income. And his taxable income after taking the standard deduction, but of course before the QBI deductions are considered, is 176. So it would look like he would get $30,000 worth of deductions, 20% times 150, limited to taxable income, 20% of 176, which is 35. So therefore, it can't be more than that. So we're okay there. We still have the $30,000. So result, we have a $30,000 deduction. But suppose his taxable income was 125. Well, that's another threshold limit here. It'd be $25,000 would be the computation. So now the deduction would be $25,000, not 30. You can see where this is a labyrinth. If you have multiple entities, this is a labyrinth of computations. And we already have the software that we use for planning that is geared to do all these computations. In fact, in most cases, we could take people's tax returns from last year, roll them in now to 2018 and say, based on exactly the way you positioned everything for last year, here's what the current year deduction would be for that. In fact, we will be approaching clients not way after the end of the tax season early because there are strategies that people need to start doing right now to get the full benefit for the year. And part of it is knowing what would be the result of taking some moves that we might be suggesting. Okay, slide 13, please. Okay, example taxable income over 415, and the prior example, we're going to say it's $1 million. They had no other qualified business income but 700,000. He has wages the wages in the company is 250,000, even including his own, just to throw that in. Assets have an unadjusted cost of 100,000. By the way, I haven't even defined what unadjusted cost is. I'm kind of saving that for later. So your tenant deduction is 20% times $1 million. Limit is now not based solely on taxable income, but it's also based on, and we're going to assume here that they did qualify for the taxable income, the greater 50% of the wages, 125,000, or 25% of the wages plus 2.5, whichever's greater, whichever's better. And that comes out to be $65,000. Of course, 50% of the wages is better, so you do want to take 125. So you can see if you happen to have a subchapter S corporation and you're the only person working in there, you say, I don't want to pay myself wages, which is a Social Security tax challenge anyhow, you might lose your QBI deduction. So there's a computation where the other one kicks in, and I didn't bother to go through and take a look at what the taxable income limitation was. So there's two examples. That's all we're going to do for the examples on this. But when we get into real estate and we get into the professionals, I'll probably do a little bit more number crunching for us so we can take a look at that. Page 13. Okay. By the way, all of your qualified business income gets added together. You take it from your share of businesses. The wage requirement that I just talked about, I think we're back to slide 14, aren't we? There we go, yes. And 20% of REIT dividends and qualified publicly traded partnership. REIT dividends, interesting issue. REITs pay dividends. They could be mortgage type REITs where basically all the income is taxable to you. It could also be commercial real estate or residential real estate. Some of these REITs take cost segregation on their real estate, which we will talk about in our commercial real estate one. And the question would be is if the REIT has no taxable, it's not a taxable dividend, it's a tax-free dividend that in effect reduces your basis, is it subject to it? I personally intuitively would think no, that you would not be able to get 20% of a REIT dividend that was a distribution that was tax-free. However, I don't see that in the code the way it's laid out. So hopefully by the time we start doing returns, I'll have something out on this, but I think it means taxable dividends, but nowhere in the committee reports or the code does it actually say that. It just says dividends, and dividends can be tax-free dividends according to the code. All right, slide 15, please. Okay, so our concepts, qualified property, very briefly, it's property in the business. It's subject to depreciation. It could be like a walk-in coolers. It could be your manufacturing machines. It could be different things like that. It's held at the close of the year. It's used in your business, and the depreciable period has not ended before the end of the year, meaning that you actually take your original cost. You don't have to take the depreciated cost, but when the depreciation period is over, you no longer can use that. So if you're relying on this 2.5% and you have lots of old equipment, that's not good news. If you have lots of new equipment, 2 or 3 years, that is good news. The depreciable period means a period not ending before 10 years after put in place. So a 5-year property ends in the 6th year. A 30-year property, which could be just made up 30 years, but I'm thinking real estate here, could end on 10 years. So this could do damage to buildings that have been in place over 10 years. There's elections that we can make, qualified type organization elections and things like that, all of which have to be defined. But for people with older real estate, we may not find this is going to help us unless we happen to have an operating entity that we can make what's called an aggregate election. But if you're leasing an old building to an entity, triple net lease or not, there may not be much in this area 20% you can get. This is a case-by-case computation. Slide 16. Okay, it does not include, again, I'm being redundant, reasonable compensation paid by the corporation to you and does not include guaranteed payments. We talked about that earlier, but I think especially for the pass-through entities, partnerships and proprietorships, I think there's some opportunities here because there is no requirement that you have to have guaranteed payments. There is no W-2. Corporation, there's always been the issue, did you pay reasonable compensation out if you're taking distributions from subchapter S. So there's some interesting arguments there. 17, please. I mentioned about REIT dividend. I gave you a little discussion on that. I question if it's non-taxable, whether you get the 20%. We'll see how that goes. Slide 18. Okay, now we're going to switch to another rule. I won't be as detailed on this because a lot of people have already heard about these things, but you have cost recovery under bonus depreciation. Someone who's done this for a while, sometimes I have to watch what words I use, bonus section 179, but in a nutshell, bonus depreciation says that if the property qualifies starting 9/27 of 2017 is going to be 100%. It was 50%. That's pretty good. Basically, it's kind of tangible personal property. It's property that basically has a maker life of less than 20 years. The common things would be obviously furniture and fixtures, manufacturing operations, coolers, stoves, anything that you could think of, also computers. I think lots of different things that you would think of as a tangible type property. Slide 19. Okay, the bonus depreciation, I'm sorry, the 179. See, I missed my terms already. It used to be the eligible property was 500,000. Now it's $1 million, and it's phased out after you acquire 2.5. This applies to new or used property. And I failed to mention, and it is an important part, bonus depreciation is for new or used. That opens up very interesting issues for what's called cost segregation on real estate. In a nutshell, cost segregation, you go in and you break out different pieces of your property, and you could you bought a building that you're leasing to your business. You bought it, it's a used one, and then you get this tangible personal property element in that cost segregation study. And there was limitations of whether it was new or used, and so you were not able to get some of the depreciation on this. This opens up the avenue for very juicy cost segregation modeling for real estate. So again, stay tuned for our commercial real estate section that we're going to be talking about. When I say commercial, it could be residential or non-residential. Usually the non-residential, we can get a little bit of a better result though. Okay, slide 20. Okay, they also include under 179, not under bonus depreciation, improvements made. And the building has to be placed in service, but there's not a 3-year rule like there was in the past. But it can include roofs, heating, ventilation, air conditioning, fire protection alarm systems, security systems. This almost does away with the argument of, do you capitalize a roof or don't you capitalize a roof when you put a new roof on? This is going to be very helpful, and in some cases, you might not need cost segregation if these are the only issues that we're talking about. So I like these. Slide 21, please. Business interest deductions. Boy, I was watching this one when it first came out with the House and then the Senate version. If you have a group of businesses that are affiliated, what's affiliated mean? Well, let's just presume you own all the businesses and you have 10 businesses. They're all affiliated because of common ownership. It can also include common ownership. It would be very technical definition, but basically could be if there's 2 partners that own all the same locations. You maybe have 3, they all own the same, and then maybe get into, well, but one person's on this one but not the other one, and the question is, are they included in the affiliated group? Interesting issues we've had to deal with before this law came out anyhow. That part of what's defined of affiliate is not changed. And it says where the gross receipts exceed $25 million. Gross receipts basically on the average of the last 3 years. And we do have clients that have this situation, and other people obviously have it too. It disallows the interest expense. For some reason, I was researching, why are they doing this? And some foundation, I guess, had an article on this bit about equity-based businesses versus debt-based businesses. I don't know why they care, but they do for some reason. And they're disallowing the interest to the extent it exceeds 30% of the adjustable taxable income. So the question is what's adjusted taxable income under this code section? And it's effectively EBITDA, earnings before interest, taxes, depreciation, and amortization. So therefore, businesses heavy intent and have lots of capital, lots of depreciation, cost segs, bonus and so on. And you say, my gosh, I brought my income so low, I exceed 25. Is there a limitation on that lower taxable income? And the answer is no, as far as right now, because it's the earnings before the interest and the taxes, depreciation, and the amortization. And you can, of course, carry this forward. However, they did slip this in there starting January 1st of 2022. After that, depreciation basically is added back in. And remember, some of our real estate heavy laden type people, depreciation, when it was added back in up to before 22, you didn't have to worry about this. But starting in January 1st of 2022, the depreciation now is included in your definition of taxable income, and that could cause problems for people. Now, who knows if this law is going to stay in place? Is it going to really change after 2025 because it reverts back to 2017 law? But I think some planning on how you're doing your long-term financing and your equity structures is some strategy you need to consider, and not doing it December 31st of 2021, but starting to plan this now. This is what I'm saying. The sooner we start planning on this new law, the better. We don't want to let it go too far. Slide 22, please. Okay, NOL carrybacks, basically, there's NOL carryback currently 2 years. That's where your revenue for your business is less than your expenses, and you can take those losses and get them for 20 years in the future. But now this loss carry forward is going to be limited to 80% of your future income per year. That's not good. It's going to eliminate your carrybacks. That's no fun. But the NOLs can be carried forward indefinitely. I don't know what the point of all this was, but here's a kicker that comes in here, is that this is for a married filing joint, once you get over $500,000 worth of losses, and your taxable income is over $500,000 without reference to this loss, you have to carry it forward. So a lot of people start up operations, if they are throwing out so much losses, they don't have more than the $500,000 income to carry forward. They may find that, contrary to the past, you may not get the full deduction. You may have to carry it forward. Okay, next slide, 21 or 23, please. Okay, accounting methods. Actually, here's something that I, as an accountant, get excited about, but a lot of people don't. I used to teach an accounting methods course for CPAs for one of these graduate programs that was out of California. And they actually had to cancel the class because there wasn't enough interest in it. But all the other classes that I was teaching foreign people were filling it up. And they finally had to make this a requirement to get their degree, and now people started doing it. So for some reason, I think we accountants think, oh yeah, we know how this works. And it turns out that how your accounting methods work could be significantly different from the way you keep your books. And so we've been taking advantage of some of these things for years with our clients, but just want you to be aware that historically, the IRS has odds with your desire to use a cash versus an accrual method accounting. Cash often delays income, but not always. Let me give you an example. You're a restaurant, you have no receivables, you have payables. Why would you want to be on the cash method of accounting? You're a contractor. You have lots of work in progress, you have lots of receivables, and you have payables, but typically the net is a positive number, meaning that you're tying up your money into the operations for working capital. Yeah, you would want to be on the cash method of accounting if you could do that. In fact, the rule used to be $10 million, and so all of our contractors, in this example, are already on the cash method, but now it goes up to 25 million on the gross receipts test. That's very interesting. There are some limitations that if you have inventory that has not entered into your production process or it has not been sold, then you're going to have to keep the inventory on an accrual basis. And there's some interesting things on that. But a lot of business, if you look on your balance sheet and your receivables, your work in progress, maybe your inventory, depending on what nature of your business is, and your payables, if they exceed your payables, you may be a deduction for this, and it's a very powerful thing to consider. In fact, I would say definitely look into this. Slide 24. Percentage of completion, here's another one. I just happen to be mentioning contractors. It used to be a 10 million threshold, now it's $25 million. And basically, if your gross receipts is over $25 million, you have to use percentage completion. But it's a 2-year test. If it's expected at the time the contract is entered into, and the contract would be over 2 years, you have to use percentage completion. If you expect to be under 2 years, it would be not subject to it. That rule used to be a 1-year test, by the way. I don't hear any commentators talking about this change. That's good. And without getting into this, there is some alternative minimum tax still, unfortunately, hanging around at the individual level. And for contractors, even use the cash method to look back to the percentage created an ultimate tax problem. This is great. This is great for contractors for a variety of different reasons. Okay, slide 25. Contractors, we talked about that just a moment ago. I got so excited, I forgot this was going to be up on the slide, but the good news for contractors. Slide 26. Okay, that brings us to an end. All good things have to come to an end, but not saving taxes. Don't let that be the end of this. Take these ideas. If we work with you, certainly talk with us. If you'd like to visit with us, even if we don't, we will be glad to do this. We can start running some of these calculations. Don't wait until July or August to start thinking about the new tax law impact on you. Start operating it right now. We do not have time for questions because I got so full of myself talking about this. But if you email them in by the end of the day, I promise we'll get back with you. I don't leave that open-ended because a lot of times people might send me these questions a year from now. So if you want to email it to me before the end of this month, this day, of today, I promise we will get back with you. And with this, I'm going to turn this back over to the person who's put these slides together, who made them really look nice, who's organized all this and understands all this technical stuff about how to make these webinars work. I'm going to turn it back over to Kit.
Hey, thank you, Chuck, and thanks for that very informative presentation. Thank you, everyone, for joining our webinar today. I do want to give one more reminder. We have 2 more webinars coming up, the commercial real estate tax changes next week on Tuesday, January 23rd, and the last one regarding professional practices on Thursday, January 25th. You don't want to miss those. If you missed our first webinar, that is on our website, the recording on our speaker series page, www.rcthornton.com. And also, if you are interested in being a part of one of these webinars, you want to sponsor one for your colleagues or maybe get it out to your trade association, please give me a call here at our office. We would love to talk to you and work on putting something together that's specific to your business. The phone number, 602-678-7067. Thanks again, and that concludes our webinar. Have a great day.